1st of August, Rexam announced its half-year results for 2014. We asked Graham Chipchase, the Chief Executive, to give us his views. Well, Graham, welcome back to another In Touch programme. The results for the first half are in line with our expectations. Could you just give us a quick summary of what happened in the year?
Well, I'm glad to say our volumes are up 4%, with growth across the whole business, particularly in the second quarter. We've had some challenges with both sales and profit growth, but cash performance has been good, so overall we've had a pretty good set of results.
Last time we spoke, you were disappointed at the safety performance, but you said that you were confident of improving it. So what's happened there?
Our people's safety and well-being is essential to our future. In the first half, our lost time accident rate improved, and 49 of our 55 plants were lost time accident free, which is a real improvement on last year. In addition, we've launched a program called LIFE, which is aimed at eliminating life-threatening injuries and fatalities across the whole company, as well as introducing a single standard of behaviour that we expect from everybody when it comes to safety.
You mentioned the challenges of sales and profit growth. We've felt the effect of foreign exchange, as have many other UK companies. But if you strip out the FX impact, how have we done?
Organic sales growth, which excludes the impact of foreign exchange, was in line with our volume growth, which is what you'd expect. However, organic operating profits were flat, which is due to the high aluminium premium costs offsetting the good volume growth we've seen.
Can you tell us a bit more about what's happening with the aluminium premium?
Aluminium premiums are the cost of storing ingots in warehouses, and the premiums affected by the load-out rate of those ingots from the warehouses. During the first half, aluminium premiums reached an all-time high, particularly in North America and Europe, so we faced a headwind of £7 million in terms of cost. There are moves to change the load-out rules in the warehouses, but until these come into force, which we don't expect will be until the beginning of next year, we'll continue to see these higher premiums, and we expect to face significant cost headwinds for the rest of this year.
Return on capital employed is still a major focus for us, as are cost and cash. Can you talk us through those for the half year?
Our aim is to maintain return on capital employed at around 15%. So at the end of this half year, it was 14%, so we're happy with that. On costs, we're on track to deliver our efficiencies of £20 million for the year, thanks to the hard work of everybody in the first half. Cash flow has been good, and we're increasing the dividend by 2%.
And we're continuing to invest in the business.
Yes, whilst keeping a strict watch on capital spending. We've got some really interesting projects in the pipeline, and we'd hope to deliver at least one of those by the end of the year. Beyond those, we've already announced, for example, the UAC deal, the new investment in Vidnau in Switzerland, and further expansion in India.
Running through the four regions, can you give us an idea how each of them performed?
Europe had a quiet start, but improved in the second quarter, and as a result, in the first half, volumes are up 3% in Western Europe. In Russia, trading was more subdued. Volumes were down slightly, but encouragingly, the cans share of the packed mix increased. Okay. Our EMEA business saw continued strong growth in India, offset by lower volumes in Egypt due to the line conversion and some softness in Turkey. In North America, our standard can volumes were down in line with the market, but our specialty can volumes grew slightly. And finally, South America performed very strongly, initially driven by good weather, customer promotions, and the timing of Carnival, and then boosted by the FIFA World Cup. Overall, volumes are up 20%, but we expect this to slow down significantly in the second half.
We completed the sale of the healthcare business in June and returned $450 million to our shareholders. Will we be doing anything differently now that we're a fully focused beverage can maker?
Well, not really. Our strategy stays the same, but what it does do is it allows us to focus on our strategic priorities as we pursue our vision of being the best beverage can maker in the world.
You've already touched on two of the strategic priorities, investing with focus and building a winning organisation. How are we doing on the other ones? For example, strengthening our customer relationships?
Well, we've made important changes to the way we're organised, so we're using key account leads to strengthen and form long-term relationships with our customers. And in addition, we're extending our contact with customers beyond procurement so that we're now reaching out to both the marketing and sustainability functions.
And what about operational excellence?
We continue to focus on lowering the cost of making an increasingly large range of beverage cans, as well as looking at alternative technologies to address the constraints of the existing beverage can manufacturing process. I'm proud that our operations were once again recognised by the Shingo Institute. So Enzersfeld in Austria became our first European plant to be accredited, and in Rio de Janeiro, our corporate head office became the first head office in the world to be accredited by Shingo.
And finally, on shaping our future, what's happening in the field of innovation and sustainability?
Innovation and sustainability is absolutely crucial to our future. So, for example, our Rexam Editions technology has now been rolled out as a global best practice. Following the success with craft beers in the US, we're taking a targeted approach to craft brewers globally. In the UK, we launched our first craft beer cans, whilst in South America, we supplied a craft brewer with our unique fusion bottles. We've also made new inroads in India, supplying the first domestically produced 250ml cans for water.
Before we finish, any closing thoughts?
Well, the business is in good shape operationally, and we've been controlling the things that we can control. So I think everybody's done a great job in the first half. In the second half, we'd expect to see the same sort of headwinds we saw in the first half, specifically around foreign exchange and aluminium premiums. But we would still expect to make further progress on a constant currency basis. From my visits to our various plants around the world this year, I know we've got the people and the capabilities to deliver on our promises and pursue our vision.